Hello everyone, my name is Michael, and we talk a lot about different trading strategies and financial and technical literacy. We also discuss how to choose the right cryptocurrency for this. There are many useful indicators, but today I want to share some valuable observations from the world of economic theory. And these can benefit not only economists and scholars, but also traders and investors. Make sure to watch this video until the end to learn what soft and hard money are, what Gresham's law is, and how to use this knowledge to select the right cryptocurrency for your investment portfolio. Like this video if you want to learn more unusual tips for selecting the best cryptocurrencies for your portfolio. Let's get started. Money is certainly a valuable thing, but not all money has the same value. Any trader who trades on the exchange and deals with currency pairs whose relative rates constantly change knows this. In fact, if they didn't change, we wouldn't be able to profit from their differences. The thing is, in economic theory, there are concepts like hard and soft money. This doesn't refer to soft materials like paper and hard materials like metal. No, these are categories that describe some fundamental properties of money. Therefore, considering these properties, we can attempt to enhance our forecast regarding the rise or fall of an asset's price in the future. Will a coin grow over several years, and if so, why? Or maybe it will gain widespread acceptance as a means of payment. From an economic standpoint, we have long had a working classification of money that can be successfully adapted and utilized in the cryptocurrency market, especially when forming an investment portfolio. But what are soft and hard money? Well, hard money typically refers to financial assets that can be used as money and that have significant resistance to inflation and devaluation. These are valuable and scarce assets that tend to appreciate over the long term, such as gold or silver. The most obvious example of hard money in the cryptocurrency market is Bitcoin, which has been growing dynamically in price over the long term since the network's launch in 2009. Yes, it sometimes falls during the crypto winters, but so far, all past crypto winters have been followed by growth. Like this video if you also adhere to the HODL strategy and believe that Bitcoin will continue to grow over the year despite any crypto winters. Soft money, on the other hand, refers to assets that are more likely to depreciate over the long term than to appreciate in value. These are inflation-prone assets. The key difference between hard and soft money is that hard money is a stable and predictable asset. Generally, they can be easily exchanged at a clear rate. In contrast, soft money is often issued by a centralized issuer that can arbitrarily turn on the printing press. This leads to their devaluation, meaning a loss of value relative to other assets. A specific case of soft money is soft fiat currency. This refers to paper government currency that faces devaluation. For example, the Swiss franc or the US dollar is a harder currency compared to, say, the Turkish lira or the Russian ruble, for example. One of the weakest soft currencies at one time was the Zimbabwean dollar, which faced the infamous printing press scenario and ultimately hyperinflation. It got to the point where the central bank began issuing banknotes with the absurd denomination of 100 trillion Zimbabwean dollars. Of course, not all soft currencies are as weak and soft as this one, but I hope the idea is clear. For some reason, one currency is hard while another is soft. The same thing happens in the crypto market. When an investor plans to invest in some new hyped or not so high project, you often hear the useful advice, DYOR. Do your own research. This advice is obvious, of course, and it's surprising how often it's ignored. The history of constant scams, frauds during the ICO hype in 2017, the overheated NFT market in 2022-2023, and similar precedents teach people nothing, it seems. Write in the comments if you have ever suffered losses from a cryptocurrency scam. Often, among the specific advice in the concept of DYOR, you will find something like this. Research who is behind the project, who these people are, and what their background is, who is investing in their project, and what is the roadmap of development. So, how is its tokenomics structured and what is its purpose? It's not worth ignoring any of this advice. However, while the first two aim to prevent us from getting involved with potential fraudsters, the last two help us assess whether a cryptocurrency is potentially soft or hard. I believe that when choosing an asset for investment and the entry point, which is the moment to buy, it's important to consider both technical analysis and conduct fundamental analysis. In other words, to follow the DYOR advice and keep track of the news background and generally understand the nature of what you are investing in. What factors distinguish hard money from soft money that are worth considering in the crypto market? First, hard cryptocurrency is more likely to be deflationary than inflationary. This means it's more likely to be limited in supply. Bitcoin is programmatically limited to a total of 21 million units, making it scarce. Not surprisingly, the developers of Ethereum have sought to create a more deflationary tokenomics model in recent years. The activation of the merge and other updates not only allowed a transition to POS but also significantly revised the emission model and introduced a burning mechanism. For this reason, many meme coins, even those considered trash from the perspective of hard money, invent various burning mechanisms. Second, a limitation in supply alone doesn't indicate the scarcity of an asset. For example, the meme coin SHIB is also limited and even decreasing in circulating supply. However, the maximum supply of the project was 1 quadrillion coins. That's too much if we're talking about real scarcity. Third, hard currency often has high value to its versatility, utility, and difficulty of production. In this sense, Bitcoin is not just called digital gold. It is the first cryptocurrency in history that has provided utility and served as a universal means of payment. And it's also difficult to generate. Mining incurs colossal expenses for equipment and electricity. By the way, extracting gold is also not a cheap and easy task. Therefore, the high and rising cost of production for both gold and Bitcoin leads to the appreciation. By the way, write in the comments what you consider to be a more reliable asset, gold or Bitcoin. Does this mean that hard currencies are always better than soft money? Not exactly. There is a Gresham's law which states that bad money drives out good. The authors of this observation are the famous astronomer Nicolaus Copernicus and financier Thomas Gresham. The essence of this law is that inferior money, for example, made from low-quality materials subject to devaluation and possessing lower purchasing power, will tend to drive out good and reliable money from circulation. That's why Bitcoin may not achieve widespread use as a means of payment. It's not suitable for this task. However, it is suitable for investment. Given that it appreciates in value, people are more likely to prefer to save in Bitcoin rather than spend it, while it's more advantageous to spend what is likely to depreciate and is subject to inflation. For this purpose, there are plenty of altcoins. Is it so bad? Not really. After all, if a cryptocurrency is actively used, then there will be demand for it as a means of payment, which sometimes leads to hype and volatility. Therefore, when you're building an investment portfolio, you need to evaluate what exactly you want to buy. It could be a soft cryptocurrency such as meme coin that becomes a super liquid means of payment and microtransactions. In this case, as its adoption grows, its price may rise sharply and then fall just as sharply. This is clearly not a serious asset to accumulate, but it can be a good one for quick profits. On the other hand, if you're investing in a serious project, you shouldn't expect quick profits. Usually, you need to be patient. But if you did your research about the cryptocurrency in your portfolio, whether it's soft or hard money, then your chances of incurring losses are significantly lower. So guys, thanks for watching this video till the end. This was Michael with you in this video. Don't forget to like, push the notification button and subscribe to this channel. See you next time guys, and bye!